I'm Alan Bleiner. I'm a professor of economics in the department here, and it is my privilege to introduce for this talk two Princeton PhDs, though not in economics, in history. Both of them learned a little economics along the way, more than a little, as you will shortly see. Peter Conti-Brown is the class of 1965 associate professor of financial regulation, that's a mouthful, at the Wharton School, where he's the recipient of a dozen teaching awards. He's also the author of a very nice book on the Federal Reserve that I had a little bit something to do with when he was a student here, as a kibitzer anyway. I don't take any credit for writing the book. And he is now teamed with Shaun Vanatta, who I will introduce in a second, on the book that you all came to hear about today. At Wharton, Peter teaches topics in financial history, as you might expect, financial regulation, which you're going to hear about today, sort of. And I was intrigued to see business ethics, which must be an interesting subject these days. You don't drift into government ethics, probably, but I think many of the same principles hold. As a sidelight, Peter, some years ago, more years than either of us want to remember, was a student in my course in central banking here, which then was called Woodrow Wilson. Yeah, we could use the term. It was Woodrow Wilson 324. Now it's SPIA 324. Shaun Vanatta is a senior lecturer in financial history and policy at the University of Glasgow, which is probably most people in this room know has something to do with the start of economics, more than something to do. Adam Smith was a professor of moral philosophy. There was no such subject as economics at the time. He is the author of a book with a fascinating title, Plastic Capitalism, which is about credit cards. And it says, banks, credit cards, and the end of financial control. I hope that's not completely true. But in any case, is the co-author with Peter of this book on bank supervision that we're all here to hear about today. Imagine, if you will, a challenge being given to two bright young, I'm going to call them for this purpose, economic historians. Write a book, a long book, on financial supervision. Make it interesting and engaging reading so that people won't stop in the middle. It sounds like an impossible task, but the two of them have proven in this book that it is not an impossible task. It's a beautifully written and beautifully thought out piece of work that I commend to everybody here. And with that introduction, I give you Peter Conti-Brown.
Thanks so much, Alan. What a privilege, a little bit daunting and haunting to return back to our old stomping grounds. Shaun and I were walking around campus and we passed by the spot where probably 13 years ago, we sat down together and said, we should write an article together. It should either be the history of the Bank Holding Company Act, or what about a history, just an article-length history of the examination report. And now, after 13 years of work, you have the book, which is kind of a history of the examination report. And it's a special privilege, too. Alan has so much more to do with my trajectory than he just admitted. When I arrived on campus in 2013, I sent Alan Bleiner, the former vice chair of the Fed, a cold email. And I said, I'm here as a history PhD student, but I would like to study central banking with you. Hugs and kisses, Peter, something like that, right? Like, so the chutzpah associated with that was rather jarring to me as I think back to that younger man. And the fact that he responded, and not only responded, but over the next few years, I met with Alan at least monthly, more often, just one-on-one, where he would tutor me on the economic side of that study. And here today also is my advisor in the history department, Harold James, who helped keep me honest as a historian, discovering the odds and ends and twists and turns along the way. So it's really a special privilege for me to be back here again to tell you about this journey, where it ended. And for that, we need to understand a little bit better, not the history of supervision, but the cutting edge presence of supervision. This is Mickey Bowman. She's the vice chair for supervision at the Federal Reserve. This is an office that was created when Congress passed the Dodd-Frank Act in the aftermath of the global financial crisis. And it was not filled during the Obama administration. The first person to hold it was Randy Quarles in the first Trump administration. And after a zig and a zag from Trump to Biden to Trump again, we have a moment happening today, right now, every day that you open the newspaper, at least one, or certain kinds of newspapers, I should say, although sometimes it bleeds into the front pages, kind of existential debates about the direction of bank supervision. We have things about where the U.S. is going relative to the rest of the world, the size of the bank supervisory workforce, those examiners that Sean and I have spent so much time studying, and even very recently, a kind of staggering announcement for those of us who watch this space, where Morgan Stanley has reshored its foreign securities office to be located underneath its national bank, where the 1999 Gramm-Leach-Bliley Act had required all such banks so organized to keep at an arm's length those affiliates. And as you look at all that's happening in the moment of the Trump administration making changes to the entire global order, you're often left with the question, how much of this actually matters? Like, where should I be excited, if excitement is your initial response to the Trump administration? Where should I be alarmed, and to what degree? How should I calibrate this? And in bank supervision, we have simultaneously a situation where the stakes are impossibly high, but the opacity is impossibly deep. And so our book is not going to do much about the stake of the stakes. Those are high, and they will remain high. But we are trying to peel back some of that opacity so we can understand just exactly what supervision is and why these changes that we're seeing in the Trump administration and elsewhere are so important. To understand this, let's think about a three-legged stool where, when we have mechanisms for legal obedience, as we might say, it's a bit of a mouthful, but just this idea that we have a government organized to say to the private actors in the private sector, there are things that you must do and must not do. The most famous of these is going to be legislation. And so for financial historians, for economists who want to think about the impact of political economy on markets, legislation is where they reach. So Dodd-Frank, Glass-Steagall, right? You think about big acts of Congress where they made grand announcements saying, so it shall be. But of course, in banking, that's not where the action is. And so some people, lawyers primarily, would say, okay, persuaded, it's not legislation, it's regulation, and this is the stuff of administrative law. It's the plumbing of the government, regulation. So we'll look here to understand, okay, just exactly what are the regulators going to do? So you learn a lot of acronyms in this space about the Federal Deposit Insurance Company, the FDIC, the Office of the Comptroller of the Currency, the OCC, of course, the Federal Reserve, more recently, the CFPB. And you ask questions about the rules that they are writing to govern this behavior. And you have constitutional battles about just how much the Supreme Court is going to permit or not permit those rules to come forth. But in banking, and here I'm going to turn to our argument, the thesis that Sean and I advance is in banking, that's not where the action is. What we have instead is this other category. It's called supervision. And it's as distinct from regulation as regulation is from legislation. In fact, we'd say more distinct. Because supervision is not simply the application of rules to action. We know about that from the study of administrative law going back many, many decades. Street-level bureaucracy, some political scientists call it. And political scientists have been focused on the exercise of discretion by government actors, from Social Security to customs to a lot of other areas too. Supervision is different from this. Supervision is different because what we ask bank supervisors to do is not simply to verify compliance to these external sources of law. And don't take my word for it. Here's a quote from 1954, right? Yep. Great. Don't have my glasses on me. this is from the much revised Purposes and Functions of the Federal Reserve. Much revised, it doesn't even have the same name today. The Federal Reserve issues this document, revises it a little more often than once a decade to explain itself to the people, to explain what it is that the Fed is about, what it does. And in the supervision regulation section today, if you look at it, it will say things that make it sound like supervision is simply the compliance function, right? It's simply to verify that rules and laws are being followed. But in the 1950s, this version, as you see, supervision is much more than that. A wide variety of functions, including the issue and enforcement of supervision and other regulations, of course, we already knew about. But from the birth of banks, their organization, periodic examinations, determinations of whether they're sound and safe or unsound or unsatisfactory, review of requests and documents and approval of proposed changes in scope, authorization of the exercise of trust powers, and on and on and on and on. And what we get from this conception is that supervision is about so much more because financial risk is so different. What we get then are three key themes about the nature of financial risk and how we can see its navigation across a public-private divide. And I'll briefly describe these themes. So the first is that divide itself, public versus private. So some conceptions of the modern state would say that we want the Weberian monopoly on violence to be restricted in its use only in the prosecution of clearly described laws, right? So if you're going to put the boot of the state on the neck of the private citizen as an individual or as a corporation, you only do that where the law has been violated. That does not describe the way that banks are supervised. Instead, what we have is this category of risk that is borne by private sectors at the front end, at the tip of the spear, but holding the spear is the government. And the line between where private and public is drawn shifts over time. It's a function of history. And it is drawn and redrawn depending on things that swirl around us in a political economy. And so it's not enough to say, as we just saw last week in this announcement about Morgan Stanley, banks don't organize financial risk, not completely. Banks and supervisors organize financial risk. And the question for historians, the question for policymakers is who makes which decisions, why, and when? Now, another is a big debate that we are again seeing today, and that is those who would wish to regularize supervision, render it more legible like rulemaking, like legislation, more predictable, fairer, more subject to traditions of the rule of law and due process. They don't want supervisors to exercise discretion. But let me tell you what one of the most important laws in all of banking legislation is. It's that banks shall be regulated toward their safety and soundness. What constitutes a safe and sound bank? Right? You can't write that down. They've tried. It's a long list, but the list doesn't work. What you end up having instead is supervisors, not just examiners, although those are the main bulk of them, exercising discretion to determine when one bank is safe and sound and when another bank might not be. And that's important, the comparison, because one bank engaging in one activity and another bank engaging in the very same activity could create very different kinds of institutions depending on the portfolio of risks that they might be subjected to. And so that question about rules versus discretion, it's a very familiar one for legal scholars and political scientists, but it's the defining ethos of bank supervision. And then finally, when we look both horizontally and vertically in the American system at the history and traditions of bank supervision, no thinking person would sit down from a blank page and design what we have today, right? Any single financial institution is subjected to over 100 different regulatory bodies in the United States alone. And that is because we have different regulators who are going to be focused on at the state level and at the federal level and different parts of states. At the federal level alone, you not only have the FDIC, OCC, and Federal Reserve, but you also have the FTC and CFPB and other entities too. And I haven't even mentioned credit unions, which, by the way, we don't do. And we received a very angry email from a credit union executive saying, WTF, we're the credit unions. And we said, you should fund our next book. So when you're talking about a bank, we have what we call federal disharmony, the fracturing of different functions across conduct, the CFPB, insurance, the FDIC, chartering, the OCC, and liquidity, which is the Fed. No other country is designed exactly like this, and no one set out to design this, and this is our point. We don't have here this big bang moment where wise and wizened grandfathers of the tradition sat down, Franklin Roosevelt, pen in hand, and said, you know what we need to do is separate bank supervision by creating a new insurance fund. And indeed, one of the things that you'll see in chapter 6 of our book is Franklin Roosevelt saying, what happened here? Why do we have so many different agencies regulating the same conduct? And Mariner Eccles, then chair of the Fed, saying, well, this was called the New Deal, right? We did this. And Roosevelt said, we should undo it. We need to consolidate it. Indeed, Sean and I count 21 different serious efforts of proposed legislation that gained momentum to try to undo this process. The 22nd was in 2025, where we had a blueprint offered by executive order. Every one of them failed. Why? Because the way that banking and bank supervision in the United States evolved was not by a big bang, but by punctuated equilibrium. Indeed, the original title of this book was not Public Finance or Private Finance, Public Power, but The Banker's Thumb, in homage to Stephen Jay Gould's Panda's Thumb. And the idea is that, of course, the panda doesn't have a thumb. He has it has an extra digit that has evolved to be peculiarly well suited to the peeling of bamboo, which constitutes 95% of a panda's diet. I know these facts only because we almost called the book The Banker's Thumb. By the way, Joe Jackson's not here, our editor. Is he from Princeton? He did not like that title. So we had to abandon it. Private Finance, Public Power became the thing. But at home, my wife is here. She still calls it the banker's thumb, which I appreciate. Our point here, though, is that it evolved to fit a purpose. And so even to this day, we have, right now, as we're watching, some of the supervisory debates happening around questions like debanking. Did banks during the Biden administration misbehave by telling conservatives that they were fired as customers? It's kind of a strange debate, but what we're seeing at the Fed, at the OCC, and at the FDIC, they're moving in different directions as they have that debate. Why? Well, because they're motivated by different things. OCC is motivating by chartering. FDIC is motivated by protection of the Deposit Insurance Fund, and the Fed is motivated by macroeconomic stability, and that's true across partisan divides. What we get then is a peculiarly well-suited system that no one would have designed, but that is resilient to an awful lot of change, challenge, and even crisis. We then end with this. This gives us 4 key insights. Supervision is first about the relationship between individuals, real people, real humans, across that public-private divide. And that happens in secret. We, in fact, think too much secrecy. There's entirely a kind of phony legal doctrine called confidential supervisory information. It's easier to get the nuclear codes out of Washington, D.C. today than it is to get information out of a bank regulator about a specific bank. That might be an exaggeration, but only just. The second is that it's defined by these evolutionary processes that are resistant to efforts to impose a single defining ethos. This is an important one because a lot of scholars who think about bank supervision, they say it is about preventing crises, or it's about promoting economic growth, or supervision is about protecting the monetary franchise of the government that they have delegated to the private sector. And we say to all of them, you're all a little right and mostly wrong. You're mostly wrong almost epistemologically, because you've misunderstood what supervision is. It's not about a defining ethos. It's about something much broader than that. It's about a discourse as opposed to an outcome. And that means that supervisors in Congress fill in the gaps of this system because it is managed across a public-private divide, because it has evolved to fit purpose. It becomes a residual category, right? It is said that if we didn't have the idea of shareholders, we would have to invent them, because shareholders for a corporation as the residual claimant get the upside and are not entitled to anything so defined along the way. And that's what makes shareholder capitalism so effective, the argument goes. If we didn't have supervisors exercising discretion on the residual bucket of risk the financial system shoots off, we'd have to invent them. And the supervisors that exercise that discretion are trying to fill in the gaps left behind by legislation and regulation. And number four, the resilience to change makes supervision so useful as both a target and a tool for politicians, not simply to push back as the political economy might shift, but to expand, to give more authority, give more responsibility. One of the most fun things to write about in this book, which ends in 1980 and the examples only multiplied thereafter, is just how often Congress would haul bank examiners and bank regulators into testimony, berate them for their failures, and then pass law giving them more power. You see it again and again and again, and that's because it's solving a very important political problem, and that is we can't predict the future. What we can do is give supervisors this authority to exercise their discretion, so when the future meets the present, there's somebody to act. With that, let me turn it over to Sean.
So in a sense, right, that's a set of key themes and the way that we see this historical book really fitting into present debates about what supervision is, how it evolved into a system that is both nonsensical and highly functional. And so what I want to do now is try to talk through a little bit of the story of how we got the supervisory system that we have. It's a story that starts in the 19th century. The early 19th century, beginning really with the founding of the United States, is an era of experimentation in banking, and then an era of experimentation in risk management. We have proto-central banking through the first and second banks of the United States. We have individual states that are chartering banks and using chartering, which is a way to kind of establish the rules under which you can form a bank, and then monitoring compliance with those rules to try to organize state-level banking. We have the development of early liability schemes, things like deposit insurance. The 19th century banking system in America is not very stable, and with the Civil War, we get an effort by the federal government to re-centralize control over the banking system with the creation of the comptroller of the currency. This is a free chartering system. Anyone who has the money to charter a bank can ostensibly do so. And there's a vision during the Civil War era that the federal government is going to play a very robust guiding role in ensuring that these banks are operated safely, soundly, and in sort of alignment with a Republican political economy that's about giving credit to small producers. The challenge is that it's really hard to supervise banks in the 1860s. Like, you're riding around on a horse trying to get to hundreds of different banks and advise them on effective banking strategy. And so we see in this first moment where there's an effort to really answer the question, who should bear the risk, the public through the comptroller or private actors? We see the public really fail. You see, first, again, it's sort of institutionally difficult to provide the kind of oversight that you want. There are corrupt bank examiners who are taking bribes to issue favorable examination reports. And ultimately, in this era of financial instability, the comptroller doesn't have what banks need in a crisis, which is money. The comptroller doesn't have a balance sheet. It cannot provide liquidity. And so you see by the 1870s a real retreat. Comptrollers essentially say, actually, it's private bank shareholders who should oversee these banks. And you see the development through the New York clearinghouse and other clearinghouses of liquidity, private liquidity mechanisms that can try to combat a crisis with the thing that banks need, which is money. Of course, if you know anything about 19th century American banking history, you know that it does not get more stable after the Civil War. You have a series of banking crises, 1873, 1884, 1893, and then finally the big one in 1907, where this sort of privatized system of financial risk management is demonstrated to not function. And so you get a new debate. We have chartering, but maybe we could think about central banking or deposit insurance as viable mechanisms for ensuring the stability of the banking system. But at this time, sort of disputants in this debate see these as substitutes. You can have central banking or deposit insurance, but you can't have both. And so as we know, the Fed gets founded in 1913, and the decision really is focused on central banking. You then have two competing supervisory institutions. You have the comptroller, who oversees national banks, and you have the Fed. And there's this sort of struggle for power through the 1920s as these institutions are fighting each other for dominance of the banking system. 1920s are not a great time for the American banking system, and so it's clear that this model of sort of competing supervisory interests is not going to work. Now we come to the Great Depression, which is really a pivot in the story that we're trying to tell. In the 1920s, late 1920s and early 1930s, the Hoover administration is really trying to demonstrate strength by keeping the banks open. The argument is that, well, the Depression is temporary. Banks are temporarily embarrassed, and once the economy turns around, these institutions will be fine. And so even though we know, as bank examiners and supervisors who are going into these banks, who are evaluating their balance sheets, who are checking out their loans, we know that a lot of these banks are insolvent now. If we just wait, then maybe as the economy turns around, these loans will be good and the banking system will succeed. And the challenge that the Hoover administration has is that the public can see day by day that these banks that the federal government, through its supervisory function, is saying are safe and sound, that they are not safe and sound, that they are failing 1 and then 10 and then 100 and then 1,000. And so you get the kind of retreat from the banking system that ultimately leads to its collapse on the eve of Roosevelt's inauguration, where state by state, state governments are closing, shutting their banking systems. And when Roosevelt comes into power in March of 1933, he takes the further action of shutting the entire banking system. And the way that we often tell this story is that it's just Roosevelt's charisma. When he gets on the radio in the first fireside chat and he says that he wants to have a talk to the American people about banking. And he talks the American people through how banks work. The idea, of course, that when you put your money in the bank, it doesn't just go in a vault, that it goes out in the economy and it works. It's that charisma alone that convinces Americans to put their money back in the banking system. But the argument that we make is supervisors all along had the information on these banks to know which ones were safe and sound. And the real power of the banking holiday in 1933 is that not that Roosevelt reopens most of the banks, but that his administration closes many of them. And it says to the public, we have done the work to know which banks are safe and which are not. And the assumption, again, in the literature is often that, well, like, how could they do this? They only had the banks closed for 10 days. There's no way they could have inspected them all. But it's the fact that government had been inspecting the banks for their entire existence, that it had this paper trail of information, that federal officials knew which banks were safe and which weren't. It now had the political authority and legitimacy to act. And so it's from that point forward, really, where there isn't this question about public or private. There isn't a question about state or federal. The federal government, from the New Deal forward, owned the financial risk in the banking system. And from the New Deal, it created new risk management approaches to dealing with it. So we had chartering, sort of creating a system of rules under which banks operate and monitoring compliance with those rules. We had central banking, which, again, is providing liquidity to banks and in some sense is guiding banks towards types of loans that officials think will be safe and sound. We get deposit insurance, so insuring deposits to encourage people like you and me not to run on the banks because we know our money will be there even if they fail. The government even experimented with ownership. Through the Reconstruction Finance Corporation, the US government became an owner of thousands of banks and exercised governance of those banks by appointing by appointing directors and managing the banks as an owner. Now, over time, we dropped that approach, kept the others, but were unable to ultimately consolidate supervision under any one vision of financial risk management. And so over time, the view was that those were complements, that it was good to have chartering liquidity, and deposit insurance. And that together, those would create a system in which risk management was tightly constrained by the federal government. Fun fact, from the end of World War II until the mid-1970s, no more than 10 banks failed in any given year. And so there's an immense financial restraint that this system creates, but it also creates a kind of public confidence in supervisory oversight to make sure that banks don't fail, which after the Great Depression is really the sort of key political goal of supervision. Now from there, once supervisors are successful at that core purpose, not having banks fail, Congress sees the opportunity to layer on new responsibilities. So it's bank supervisors who have this information about banks. They know what's going on inside these institutions. And so when Congress is worried that banks are getting too big, because in the 1940s and 1950s, banks start to merge, seeking economies of scale, those in Congress who favor smaller banks, who prefer an anti-monopoly ethos, put it off to supervisors, give them new responsibility to supervise anti-monopoly policy. And when supervisors don't do enough to stop the mergers of big banks, Congress gives them, as Peter suggested, yet more power to oversee that process. Then when we get the civil rights movement, the women's rights movement, and other sort of political challenges to the legitimacy of the banking system, banks are not making home loans to Black Americans, banks are not giving equal credit opportunity to women. Congress, again, pushes that responsibility onto the supervisors. Now, in this moment, the supervisors are saying, no. We're here for safety and soundness. We don't want to oversee anti-discrimination policy. We definitely do not want to oversee equal credit opportunity. We have this great image from one of the congressional hearings where the banks are described as holding on, like a Disney movie, of a bear holding onto a tree as its fingers are slipping off, being pulled into these policy areas. The supervisors don't want to do this stuff, but Congress compels them to do it because they have the information, they have the insight, they have this tight relationship with banks, and so they're the ones who are going to be dragged into this policy. And so throughout the arc of the book, there's this story first of experimentation in the 19th century. There's a solidification with federal backstopping of the financial system during the New Deal. And then from there, the layering on of further responsibility into the present. And so that's the story. And we look forward to having a chat about it. Thanks.
Well, thank you both very much for those fine presentations, summarizing a 400-something page book in small font, by the way. I can testify with my aged eyes, it was a little bit of a struggle to read some of it.
We have two complaints for Joe Jackson, that SOB. Where is he?
But it was worth it. I want to start with something that's going to sound slightly unfair, but it's not really. Your history really ends in 1980, but I want to ask you about a very recent episode. The reason it's not unfair is you start the book right at the beginning with Silicon Valley Bank. And I'd like to hear one or both of you, I have my own opinions on that, but they're irrelevant here, opine on the performance of the regulators, supervisors in the Silicon Valley Bank case.
You know, the story of Silicon Valley Bank and its crisis and the crisis that it initiated in the spring of 2023 is one where we have an awful lot of angry citizens wondering why, just 15 years after the global financial crisis, we have the government bailing out private citizens again, although the Biden administration insisted that these weren't bailouts. Of course they were, because we had uninsured depositors not legally entitled to being made whole, and the government made them whole. And so you get a lot of anger at the bankers for taking risks with public money in this sense. Then a lot of questions about where were the supervisors. And what we would say is that without a better understanding of bank supervision, it's essentially unanswerable. And here's why. We don't know, and the Fed issued a report in May of 2023 that didn't shed a lot better light on this question. We don't know if the crisis of 2023 was a resounding supervisory failure or if it was a resounding supervisory success. And that latter hypothesis is perhaps a little bit hard to see, but let me spell it out. The failure seems obvious enough. Supervisors should have been able to call the tune that SVB was dancing to and say, you know, the basic story of SVB was that they had a gigantic balance sheet that swelled during COVID-19 and the year before of plain vanilla assets, very, very safe stuff. But then as the Federal Reserve was caught flat-footed in an inflationary spike and then started their rate hikes in Q2 of 2022, it didn't sell these securities. It didn't redo its balance sheet. And so as a result, as interest rates go up and the assets were yielding interest rates, their ability to generate net interest income, the holy grail of banks, was severely impacted and it became insolvent. So where were the supervisors? Why didn't they tell them, get your act together? The problem with that theory, it may be true, but the alternative is that there are some 4,500 banks in the United States. The best estimate we have from work by Amit Saru and his co-authors is that about 400 of them were similar to SVB in the sense that their balance sheet was weighed down with these assets that couldn't generate net interest income. What about the other, 4,000? What we don't know, because of confidential supervisory information, is how many of those banks exited the trade during the critical 4-month period when the Fed was still buying up, swallowing up a huge amount of these assets while signaling rate hikes were coming. This was in Q1, Q2, 2022. What we know anecdotally is that a lot of banks heard from supervisors, you're on the wrong side of this trade, and then sprinted into the breach, pushing that again onto the Fed, and then exiting so that they were not at a failure risk. That's why I say supervisors behind the scenes for the banks that didn't fail, the shoes that didn't drop, might have been an incredible success story. And indeed, the best work on this that we've seen that came out after our book is an article by Jonathan Rose and Stephen Kelly where they say, this is not a regional bank crisis. This is a bad bank business model crisis. And we've got a couple of banks that were really bad at banking, and they failed. And so I think the supervisors got an awful lot of mud kicked in their eye without corresponding evidence.
Do you want to add anything to that?
Well, all I would say is we take a step back and ask the question, why is it the government's responsibility to make sure that banks don't fail? That we take it for granted that the government has a risk management function over the banking system, and that's not a given, right? And so part of the point of the book is to explain how we got to a point where we would even ask this question, why did the government let us down in this case? Why is the government there at all?
So this was justified by the systemic risk exception. Arguments were made at the time and since that Silicon Valley Bank was not systemic. It wasn't that big. We're not talking about Chase or something like that. It was an above average size bank. And the argument was made at the time, I just heard the number 450 or something. There weren't that many banks like Silicon Valley Bank. A slight bit of evidence of that is that there was only one bank, Republic, that sort of followed Silicon Valley Bank into oblivion. So the pardon me, it's that time of year. The question is whether that was a justifiable use of the systemic risk objection or versus building moral hazard for the future, right? The argument made on the other side is you've created more moral hazard than you had before by expanding the terms and reasons on which the authorities, let's say the Federal Reserve, will bail you out.
Lyndon Johnson, when in 1967, when faced with mounting overwhelming evidence that the Vietnam strategy was a total and abject failure, said that his choices were between something like committing suicide, which would be withdrawing from Vietnam, and then asking someone else to commit homicide, and he didn't want to die in either situation. There was just no good option. My most empathetic to the Biden administration self would say they face an impossible task because they had to gamble. They had to say, let us not trigger the SRE and see what happens, and then if it ends in financial cataclysm, not only they're politically responsible, but the harm done to the overall economy would be devastating. And if they did what they did, they're of course subjected to that same searing criticism that they have just made it so that the era of limited deposit insurance is over. The era of resolving too big to fail, which was the conceit of Dodd-Frank, it never was real. The entire idea of orderly liquidation, which is the crown jewel of Dodd-Frank, is fake. And that's kind of where we were. What do I think they should have done? I think they should have committed homicide. I think they should have killed the bank. I think that we built a system spending just untold billions and untold hours to allow banks like this to fail in an orderly way without injecting that moral hazard, that additional liquidity, without bailing out the entire stablecoin industry. Did you know that Circle was the single largest counterparty of which three banks? Signature, Silvergate, and SVB. You know what that tells us? They were not unlucky. They were incredibly smart. What they did was they figured out a way to game that system so that they were taking on the most vulnerable banks, wagering that they'd be bailed out. So they broke the buck, which stablecoins are not supposed to do, and they gambled and won. So in some sense, you just have to slow clap for Circle because they figured that out. In the other sense, you should be outraged by it, and they should be outraged at the Biden administration for making good on that bet. So I think this is a moral hazard story, but I also recognize that if I'm Janet Yellen or Jay Powell, in the moment of March 2023, and you're hearing these phone calls from bank CEOs and the San Francisco Fed president and many others, that Twitter has caused us to lose $40 billion in a single afternoon, then your finger gets itchy on the systemic risk exception. And what I wish we had done was just have a little bit more faith in the previous incarnations of Janet Yellen and Jay Powell, where they were still in office and trying to design this Dodd-Frank, because I still believe in Dodd-Frank. But not a lot of people did in 2023.
Sean, do you want to add or subtract anything from that? My 2 cents is I felt that way at the time. I wasn't, much as those two people that you named are friends of mine, and I hate to say anything against them, and I didn't in print, I thought that it was a mistake to bail them out.
I know them both too. I'm not as close as you are, and I condemned them in print at the time. I think they made the wrong call.
Let me change the subject. Peter a little bit and Sean a lot talked about free banking and the problems it led to and its demise, so to speak. I'll put the question briefly, but I'd like you to expand on it. Is crypto the free banking of the 21st century?
I mean, I think what makes banks dangerous is that they create money from nothing, essentially. Is that they are able, in making a loan, to create a deposit, which is itself money. And if that loan goes bad, or if they make that loan in bad faith, or if any number of other things happen, money that you and I depend on sort of vanishes, right? Or it becomes uncertain or illegitimate. And so giving money creation power to private actors with minimal and or no oversight is to invite that kind of behavior, where there will be many good actors who design businesses that are meant to succeed in the long term, and there will be many who create politically motivated meme coins which enrich themselves but have damaging consequences for the financial system. So in some sense, right, free banking actually was a well-regulated form of banking. There were rules that you had to abide by. There was a supervisory system put in place where those rules were monitored and enforced. And so I think the critiques that we often see by scholars who dislike crypto saying it's like free banking actually was a somewhat functional system. It didn't work all the time, but it was better than the non-oversight that we see in crypto.
So crypto is more dangerous than free banking.
That would be my view. Yeah.
Peter, you have anything
I'm
to
a
add?
little, not much. I think that's probably my view too. I think that crypto is the domain of money launderers and hucksters overwhelmingly. They're certainly the ones that provided the use case in the long incubation of especially Bitcoin. What I don't like about the crypto discourse largely is that it has swallowed up so much that we might be talking about digital and technological revolutions and payments, which are separate from crypto, but travel by under the banner of crypto. You're not allowed to talk about central bank digital currency in 2026 America, but you can talk about like crypto projects inside central banks. It's the same thing. And it's also the fact that we have digital currency. We've had digital currency for many, many, many decades. And so incremental improvements or new and revolutionary improvements in the technological apparatuses that facilitate payments are happening all the time. I resent a little that so many of them are folded under crypto, but such as they are. So in that sense, crypto is important because it's just technology, it's just innovation. But the idea of Bitcoin and Tether and China's CBDC, I think represent genuine risks to the system, but also represent a kind of surging frontier of technological innovation that we've seen sort of consistently throughout history.
That answer leads very naturally to the next thing I wanted to ask you about, which is the age-old trade-off between innovation and safety. When I was a bank, I used to say bank regulator. I think I was more a bank regulator than a supervisor.
You were, yeah, for sure.
Yeah, so I'm still right on that. Anyway.
Unless there's a part of your history I'm not aware of with you.
No, I wasn't doing that.
Yeah.
And I didn't have a horse either.
So back,
There's still time.
yeah. So in the 19th century, when Alan first was a bank regulator, the horse-drawn examiners were doing something else. Yeah, got it.
Anyway, when I was a bank regulator, I used to quip that our objective was to stay 1 or 2 steps behind the market. That is, getting as fast as the market was impossible. But if we were 1 or 2 steps behind, that wasn't too bad. If we fell 5 or 6 or 7 steps behind, we were in trouble. We were in potential trouble, and that should be our objective. How do you react to that?
So I think,
Based on the history you've been talking about.
no, I think like one way I think about it is one role supervision can play is it can help bankers, especially small bankers, understand and grapple with these technological changes in a way that maybe identifies and instills best practices, which may be difficult to do otherwise. So I wrote a book that's a history of the credit card industry. And one thing that bank supervisors are doing in the late 1960s when American bankers all dive into the credit card market at once is they try to actively identify what are the business strategies here that will be successful, what are the business strategies here that will be risky, how can we educate bankers on how to adopt this new technology in a way that is, good for them, but also socially useful, and which will, very importantly, forestall regulatory efforts driven by angry consumers who don't want to get unsolicited credit cards in the mail from creating a static regulatory regime, which will make it difficult to innovate in the future. And so supervisors are on the front line in Congress arguing that we do not want credit card regulation because that will freeze this new technology. And what we want for consumer well-being is financial innovation, but innovation in which supervisors are playing a role helping banks manage it. And I think that you can look at many instances in history where that's the positive role that supervisors are playing at this boundary between enabling innovation and not stifling it with rules that are passed before we really understand what the technology is about and what it's capable of.
Good answer.
It is a good answer. Could you relate that to where you started your slideshow, which was the Basel III Endgame and Michelle Bowman?
Yeah, that's a great.
The banks just defeated the Fed.
They did in pretty extraordinary fashion. And I'm gonna.
You probably should take a minute or two to
explain
explain
what
it,
happened.
which I didn't do.
Yeah. So, in the way that government bureaucracies work, in 2011, we had a proposal called Basel III. Basel is a city in Switzerland where international community gets together to talk about how we should think about bank regulation and supervision. And so in 2011, there was a proposal that said, so world, this is how we should do it. And we're all signatories, but of course, this isn't a treaty, this is an announcement, so it has to be domesticated. Legislation has to pass to implement it. And in the United States, we still have not implemented it. That was 2011, right? You thought our book took a long time. Basel III has taken a very long time. In 2023, Michael Barr, the second vice chair for supervision, made a big, long proposal. And it was going to dramatically increase how much banks had to raise from shareholders to fund their businesses. And this really matters because if you can raise money from debtors, depositors from the capital markets, then you're going to be able to make a lot more money on the spread in good times. Now, financial economists here just heard me violate one of the 10 commandments, which is the Modigliani-Miller theorem, which shouldn't matter whether you're funding with debt or equity, absent frictions. Well, let me tell you, our book should have been just called The Frictions of Modigliani-Miller. I mean, this is nothing but frictions everywhere you see. And banks economize on those frictions. They want to have as little capital as possible. And the Barr Fed wanted to have a lot of capital. And that proposal, Alan, I don't know what you thought of it, but there was some sloppy drafting in it. I mean, there was they threw a lot of spaghetti at that wall, and the banks just lost their minds. You couldn't listen to a podcast about finance without hearing threats that the entire economy was about to erupt in nuclear warfare because of Basel III. You couldn't watch a football game without seeing a commercial paid for by the bank lobby. So they went to war and won. I was very upset about this because this is the politics of bank supervision in the very best sense in that the 2020 election, whatever Donald Trump has to say about it, was won by Joe Biden. That means that we should have seen a different implementation, different orientation around questions that are unanswerable about growth versus stability. I mean, you want both, but if they trade off each other, what's the best way to identify exactly where that equilibrium will lie? Well, everything we have ever tried is terrible, and democracy is the least terrible, if I can be a little Churchillian about it. And so Barr, a Democrat, says we're going to raise capital. Why? Because he wants more stability. Democrats want more stability than growth. Banks don't want it, they fight, they win. And so now what we're seeing is a dramatic reorientation toward growth rather than stability, less capital for banks. And do you know, I'm not as upset about that now because we had another election since then. And Donald Trump won that one. And I think it's appropriate after the Trump election for capital to go down consistent with the Republican Party coalition that takes that view, because technocrats can agree on an awful lot in bank supervision, but at the pointy end of that pyramid, we're no longer at technocratic consensus. Like what coefficients should we put in front of a mortgage or this kind of asset or that kind of asset in banks? There's not an answer. You can't divine one from a technocratic consensus. So that gap needs to be filled by that political salient. So in that sense, I think what we've now gotten, in the last 2 weeks, a proposal from the Bowman Fed, which looks nothing like what Barr tried to do. It's the polar opposite. It leans very heavily into a pro-growth strategy. I think that's appropriate. That's the way that the government wants to do. It's certainly not, it doesn't strike me as kind of grotesquely irresponsible in that sense. I think it just follows the election. I wish that banks had allowed the 2020 election to have the same impact that the 2024 election has now had.
Okay, thank you very much. I think it's time we open to the floor. We have a lot of knowledgeable people about banking here, starting with Carolyn Wilkins right in the front.
Hi, thanks. Thanks, Alan. Thanks so much for, it's just an excellent read, and it's also very timely. And I want to just ask a question that leaps off the last thing you said about the appropriateness of the elected officials to determine where that line is, where the risk tolerance is, and how that translates into regulations, and maybe even exact numbers. There's been a lot of talk at the same time about central bank independence, but it's really focused on monetary policy. But of course, the same thing applies to the regulatory side, both regulations, so the adoption of the regulations and also then the supervision. And so how would you define the importance of independence on the supervisory side and how that's evolved over history? Because I'm sure that there's been different philosophies, particularly with respect to forbearance. And then where do you see ways we can improve that or the structure of it? Because for me, when there's a lot of discretion and the objectives are multiple and and the tools are multiple and very technocratic, there's no measurable outcome when they've done a good job. I mean, nothing happens. So how would you frame that in a way where you learn lessons from history?
Well, the
Simple
book.
question.
Yeah, well, the book that I wrote as a little grasshopper at the feet of my great patron, Alan Blinder, is called The Power and Independence of the Federal Reserve. And boy, have I got a book recommendation for you. So go check that out. I've got whole chapters on this. Briefly, what I'll say is the theory of central bank independence, as you say, makes abundant sense for monetary policy because the preferences of the polity are not divided by a partisan coalition. As we saw in 2021 and 2 and 3, Americans hate inflation. Republicans, Democrats, it doesn't matter. They also hate recessions. What surprised many of us is that they hate inflation apparently even more. And so we have the structural aspect where we have a universal opinion. And so the technocratic consensus, we're not at the pointy end. I mean, we might be size of a balance sheet, should we have ample reserves or scarce reserves? Is it appropriate to have a standing repo facility? How do we want to do this or that? There might be places where the experts no longer agree. But the basic architecture of being able to keep your eye on a ball and say, we have primed to pump too much or too little is something that there's just overwhelming democratic legitimacy behind. We don't have that same consensus on how to capitalize banks or how much community reinvestment we should be done or how that should be structured, or whether we should be penalizing banks that get overexposed to certain industries that might carry certain reputational risks. There's a lot of partisan content in those different claims. But the point that you're making is a good one, which is you pick up one end of the stick, you pick up the other. And the Federal Reserve is a thing, it's a body. And so its independence, it's the inability of the president to fire members of the Board of Governors, the quasi-private status of the reserve banks, its funding mechanism through the proceeds of its own balance sheet as opposed to appropriations, that the independence of the research function, that covers every aspect of the Fed. And that's a little bit dangerous for the Federal Reserve in 2025. Because you have a motivated president who's willing to use lawfare and personal humiliation and even threats of criminal indictment in order to bully the Fed to lower rates. Where at the same time you also have a Federal Reserve that is making politically inflected decisions around supervision and regulation. They're different epistemologies. So naturally you'd want to say, we should separate them, and a lot of people say that. But again, as our book shows, good luck, right? That omelet has been made, those eggs are cracked. They're not going back together. We're not going to wipe the slate clean. What we have instead then is workarounds. And that's why I, as someone who believes deeply in monetary independence of the Federal Reserve and other central banks, I am much more willing to have a greater appetite for politicization and supervision and regulation because we want to see, I think it would be a disaster right now for Michael Barr to still be vice chair for supervision proposing rules that look like a Democratic preference during a Republican administration, during a time when the Republican administration has declared open war on the monetary independence of the Federal Reserve. It's too noisy a signal. It's much better to have clarity around these kinds of things. And I'm going to be making the same point in 2028 when, if I can confess as a political independent, I will be voting for any Democrat with a pulse. When that happens, you'll want to see that reorientation, but not on monetary policy. You want to see the through line there.
Krisha,
Thank you so much for coming.
wait for the mic.
Thanks again. My question is to both of you. You're on a panel with an economist. You're both historians and a lawyer in your case, Professor Conti-Brown. I'm curious to hear about what your different traditions bring to the table when it comes to thinking about supervision, financial regulation, and are there things that economists maybe overlook when it comes to trying to study these things? Thanks.
So I think part of it is to not focus so much on rules, right? So a way to step back from understanding or looking at a financial system and evaluating, well, how do a different set of rules shape outcomes? It requires understanding that actually there is this process of discretionary risk management that is, I think, hard to see and hard to measure. And so if the ambition is to sort of measure the consequences of a certain set of policy decisions, it's to be sure that you can actually identify that in a world where supervision is often opaque. So it's not as clear whether what Congress said should happen is actually what's happening. And then I think too, it is this issue of historical evolution that sort of building on that point, once a system is put in place, it changes shape and scope. And so I think a lot of Peter's colleagues in law tend to see these founding moments. This is the emphasis on the Big Bang, right? There's a kind of legal originalism to bank regulation that's trying to say, well, what were the institutions designed to do by their founders? And how can we then think about supervision and regulation in the present based on those previous understandings? And there's good reason to do that given the sort of strong preference for originalism among certain Supreme Court justices and others. But that misses how these institutions actually form and change over time, and what they're meant to do now is much different than what they were founded to do. And to some extent, because Congress enables them to continue doing that, we should understand that that is the kind of policy preference and intention, so far as there is any intention in the system.
I'm tempted to say,
Oh, go ahead,
yeah,
please.
no,
go ahead.
I'll be very brief because I'd rather hear the question. I'm tempted to say, if Sean says what we really need to do is not pay attention to rules, I think what we really need to do is pay attention to rules, right? That's the lawyer in me. But here's what I learned as a lawyer historian, and Alan represents the very best tradition in economics of this too. You need to know real things, and you need to know a lot of them. I remember two things, Sean, I learned so much from Alan, but two things that really jumped out at me as I started my history program. He said, one thing was, Peter, one thing I've always wondered is we need to get to the bottom of the Fed's responsibility for the 1937 recession. And I was like, no, he was like, absolutely. And I left, and I was like, oh, I need to go learn about what there was a recession in 1937. I didn't know that. And I didn't want to admit that to Alan, because you're a historian, obviously this is very important. So you know this, you need to develop this. And I was like, oh, I did not know that at all. And the other thing was, in my oral exams, Alan was quizzing me about what interest rates were in 1982, because they were at 4% when the Fed reinstated, or 1984, when they were still at 4% when the Fed desisted from its monetary targeting, monetary aggregate targeting. And the fact that Alan just had these at his fingertips, well, of course, what's the point of that? Is that the Fed had declared inflation licked, essentially, and that it's wild experimentation that caused the greatest recession since the 37 in 1982, when inflation was intolerably high, even so, by today's standards. So his idea, and he was, of course, a scholar writing about this at the time, kind of shows this isn't about models, it's not about theories, it's about just knowing lots of things, right? So when I meet economists who I think are absolutely spectacular at understanding institutions and interest rates and flows, it's because they don't just have expertise in the traditional models and theories of economics and the mathematics of it all, even though they have that too. It's they know lots of things that are real. And I think when I meet historians and legal scholars, that's what they all have in common. So my advice, and I think Christian, right? Yeah. Yeah, so my advice to you and to anyone else who wants to become a scholar in this field is just learn a lot of real things in these fields, and be ecumenical about the disciplines that you're participating in.
Harold James. The mic's right there.
Thanks. Absolutely fascinating. And I wondered, in terms of your last answer, does it help to compare the story that you're telling with the story of other countries? And in particular, I'm struck, you can tell from the accent, that I come from a country where there are very, very many similar things in common with the story of the United States, but one of them that is not at all similar is the story of banking supervision and regulation. So there's basically no banking supervision and regulation until the late 1970s. So it's the 1979 Act that introduces this in the UK. And I wonder what difference that makes to your story. Because if you think, the story of stability after the Great Depression and after the new approach, the UK had really complete stability in the financial sector between the 1860s and 2007, 2008. And really very, very little to do with banking supervision and regulation. So it might be worth having a comparative story. And part of the convergence story that I think you get from 1979 or the 1980s is that this is the period of enormous technical transformation in terms of computerization and the application then of computers to risk modeling and the development of risk models, risk metrics in the 1980s and 1990s and the internalization of that. So that you say then in the 1990s there's a kind of growing consensus that you can actually leave the story of assessing yourself to the bank's own models. And the Basel II story is exactly about that. But that's about a convergent world. And until the 1970s and 1980s, there really wasn't that convergent world.
So I think part of it is just a question of bank size, arguably. So the UK, Canada have big banks, and for a long time, so it has a lot to do with the kind of specific American political tradition in which big banks are not trusted, and we have a system where we have thousands upon thousands of small unit banks. And even as bankers and policymakers in the early 20th century begin to see bank size as a risk management strategy of equal value to central banking or deposit insurance or any of the others, the political resistance to creating larger banks, which can manage risk internally, is so strong that that's then the fight really from the 19-teens, 1920s, well into the 20th century. And so I think you're right, Harold, that risk modeling is one reason for convergence, but another is eventually the US gets big banks. And so it then has a banking system that in part looks like these other banking systems. But I think if you look at a country like Japan, where there is an effort to adopt US-style bank supervision once they create a national banking system modeled on the US system. Maybe in some of the, I think when Sweden adopts too, they have more small banks, and so bank size may be one kind of precursor to understanding which kinds of countries adopt this and which don't. I think there is also something particular to the American political tradition that helps explain certain balances between public and private, the challenge of federalism, where you have both state and federal bank chartering, and so the fragmentation leads to more experimentation and maybe more risk at the same time. And so that's why supervision evolves in a particular way in the US and not in other places. It really feels like a general's exam when Harold asks a question like that.
I'm having flashbacks, because Harold was also on my committee, and he said, tell me about the impact of Reg Q, including its initiation and its end. And I said, Harold, you didn't assign that on my reading list. And then I had lunch with Sean right afterward, and I told him about that question, and then Sean gave me this 7-paragraph essay, and I just wanted to kick him in the shin. I was like, all right, where were you earlier? I don't even remember what I told Harold. I probably made something up. Turned to Alan and said, well, the 1937 recession is really important because...
Michael Bordo.
Yeah, so this is terrific, really excellent. I taught financial history for 40 years, so I know this story pretty well. My comment question echoes what Harold said, which is it's really path dependent, and it's the choice of a banking system which depends on a lot of other factors. It goes right back to the beginning. And because of that, okay, you've got this special US story. I've done a lot of research over the years comparing US and Canada. He looked at the UK. And again, they just didn't have these problems. So that is the story. It's the path-dependent story. But I had another question, which is in the U.S. context, going back to Henry Simons, Milton Friedman, they always made the case for narrow banking. It's still around. I mean, that seems to be one way that you can actually, if you had narrow banking, you could simplify these issues a lot.
Just to clarify, a narrow bank basically buys T-bills.
Yeah. You want to take it? You want to take it?
I guess like my response to that is just that the function of the banking system is to take risk, and it goes back to Peter's point about, or one could argue that the function of the banking system is to take risk, that we have a constant political debate or open question about how much risk taking we want in the financial system and who we want to organize that risk taking around. And so that may be an option, but it also then forecloses a certain kind of entrepreneur sort of directing that risk taking as opposed to government or other sources.
I think what I'd add is my favorite chapter in the book is chapter 8. And this is about a forgotten regulator and supervisor, James Saxon. He was the Kennedy and Johnson administration's comptroller of the currency. He fought with everybody, and what he had the integrity to do is fight with them in the pages of the New York Times for attribution. So he basically, we think he kind of is insinuating that the Kennedy administration are a bunch of philandering adulterers who won't support issuing new bank charters. He does that because he thinks that they honor the Sherman Act more than the Ten Commandments. We think that's an arch reference to John Kennedy's famous philandering. We're not quite sure, but yeah, that would have been consistent with Saxon to do this. He fought with everybody. What he was fighting for, and he took out, he wrote op-eds saying that basically Washington and the nation are full of racists and banks need to start lending to black people. And he also wanted to give, some state bankers said that he was handing out bank charters like hot dogs. And Saxon said, yeah, guilty as charged. We want to see so much more bank competition. Why? Competition for what? Not who can own the most T-bills. It's who can have in their assets, on the balance sheet, these loans that are themselves a little speculative. He wanted to see more bank failures. When the bank failures occurred, we cover some of these in chapter 8, they were hilarious, over the top, people who are corrupt and crazy and colorful. And Saxon sits in his congressional testimony when the heat is coming down on him. How could you have given a charter to this guy who was bribing people with cufflinks and eighths of whiskey?
Cases of whiskey.
Cases of whiskey, that's right. Cases of eighths of whiskey. And he said, yeah, that one didn't work out. But look at all the other ones that did. I see those failures as an example of success. And that's a really interesting model of banking. And that's leaning into that risk-taking, trying to get more people, more communities, more industries exposed to what is at least correlated with, you say all that you want about the American banking system, it's at least correlated with an economic miracle the likes of which we haven't seen anywhere else in the world.
That seems like a good note to end on, and the clock says it's time to end. So please join me in thanking our two speakers.
Thank you.